We are here today with Chris Cogswell. He's a buddy of mine for several years. He really wanted to talk today about ethnic hole-in-the-wall restaurants. But I said, Chris, you and I talk a lot about the market and the economy, and because we're both involved in investment management, we have sort of our own language and our own type of discussions that a lot of people never get to hear. And so Chris and I were about to engage in a discussion like that. And I said, let me click on the recorder and let everyone hear the real discussions that we have, minus all of the kind of Wall Street jargon, so that people know that we too are a little bit concerned about crazy markets and what goes on. So Chris, this is our secret private discussion, which I have to tell you, there's probably a few million people going to tune in.
I'm glad to be here, Doug. Thanks.
So listen, first, tell me, what's your favorite ethnic hole-in-the-wall restaurant?
Well, unfortunately, it's no longer there, but it used to be called Sari Sari, which is a Filipino term, and it was a Filipino restaurant that had all of 6 tables. And when you walked in, you thought, boy, I'm back in a developing country. The food was great, the people were great, and it was perfect until it closed about 2 years ago.
And it's in the Philippines?
No, it's in Louisville, Kentucky, in the middle of, practically the Midwestern United States.
Unbelievable. All right. So, sorry, it closed. We therefore won't do a big plug for it. Let's talk for a second, just because I don't know what you're finding, but I'm finding that my clients are saying, Doug, they're raising interest rates and the world is insane. What should I do now? Do you feel, A, they're raising interest rates, and B, the world is insane?
No, I'm not afraid of rising interest rates. The world is not insane. It's probably acting rationally underneath. It's just that nobody sees it. And frankly, if you believe in sort of the free hand of the market, it's probably acting exactly the way it's supposed to, which is rationally. It's just that it's made up of millions and millions of people, right, acting in their own best interest, which is the way markets work. And so I don't think it's insane at all. I think it's normal. It's just that, from a 30,000-foot level, you can't see it acting rationally. It doesn't look rationally. But each individual underneath is acting as they're supposed to.
So you're a big fan of this sort of free hand of the market thing. It's actually funny because certainly in the States, when people are talking about this, they're saying maybe it's gone too far. Look how a lot of people are really suffering, and the money managers, they got all the tricks and they're trading so fast, no one can even make a move. How do you feel about that?
It's interesting. I had a discussion with, and I know we're not supposed to do this, but with a guy that manages...
Chris, this is a secret. No one's listening. It's just you and me.
Right, okay. So
he
manages money for big institutions, right? And he found out that you talk about, all of this really fast, high-frequency trading, that in fact, the high-frequency traders were getting there ahead of the other big institutions, and so the institutions can't keep up either. So in a sense, when I was talking with my friend about it, it made sense, at least it does from my perspective, that you shouldn't even try it. Even the institutions are getting beat up with it. Mm-hmm. You should actually have a plan, work the plan, and don't freak out when the markets get a little volatile.
Yeah, that's how I feel. I feel that, if you are trading and the speed that you can click send to enter your trade really matters, you're probably going to not lose because some high-tech trader is ahead of you. It's just because how can you possibly make decisions that quickly and that well? And, all the academic studies show that people who do that just end up really messing themselves up.
Exactly. And the corollary is what I just said, which is even the institutions do it badly.
Mm-hmm. Well, you are...
So there's really no argument for kind of trying to beat it.
Yeah, well, if you can't join them, do you think does that apply here, or it just doesn't?
No, not at all. It's interesting. When you manage portfolios, you really want to say, and I can feel comfortable saying, I'm going to have a strategy, not a short-term trading approach. I'm going to have a long-term strategy, which is at least 12 months out. And I'm going to feel comfortable that I've got good resources and a good plan, and the clients know how things are generically, hopefully, supposed to work, right?
12 months. So why do you say 12 months?
Once you get below 12 months, that's what we in the business call tactical, right? Mm-hmm. And that's when you start getting into high frequency stuff, because if you say, well, I'm going to go shorter than that, well, why wouldn't you all just go all the way down to, as short as nanoseconds? Why do anything with 6 months when somebody else can beat you to that? So you very quickly get, you work yourself down to lowest common denominator, which is as fast as you can get. And that's, as we discussed, not where we want to go.
So you and I think, definitely are on the same side of the table as far as trading, because I also am not really big into trying to trade and not into the tactical thing. In fact, I always like the comparison because I wrote this book about chess and investing, and I remember
Right.
when I wrote it with a woman who's a world chess champion, Susan Polgar, and we once played a blitz game. And so we put the timer down, and she said, blitz game is where you get 5 minutes aside. And she said, Doug, you take 5 minutes and give me 1 minute. And so it means that I had 5 minutes to play my whole game, and she had 1 minute to play her whole game. Obviously, I lost,
Jeez.
but she had her whole game. Her timer went from 1 minute to about 43 seconds, meaning she was able to do a whole game in 17 seconds. And I think that's a good comparison between institutional tactical traders and normal people who, if you can't, compete, then don't even get involved in that game.
Well, but here's something interesting. So I was on a conference call a couple weeks ago, and one of these great big platform guys out there that reviews hundreds and thousands of managers, institutional managers of money, they found that even the institutional managers that tried to do tactical last year failed miserably. So it's one of those things. Again, it gets back to the point. Tactical doesn't really work, even for institutions a lot of the time.
Okay, but now secretly, and again, this is just between you and me,
Sure.
I happen to know that, Chris, when you manage portfolios, you often will move to cash, which seems to me like a tactical decision, in order to protect from the downside. Am I letting people in on a secret that they shouldn't know about?
No, not really. I think that what we're doing is we're recognizing the fact that volatile markets, and this is key in understanding this, volatile markets tend to go down more often than not. So what we're saying, we're not running away from the market. We're actually understanding the market better and saying, if the volatility is going up, we sense that we'll probably head down more than we will up. So we'd rather not be in a down market. We're still participating in the market, just in a different way than being fully invested.
Wait, what does that mean? Hold on.
What
does it mean you're participating if you're in cash?
Well, that's still part of the market.
So interesting. So you define cash as a strategic asset, as opposed to other people who just say, "Gosh, I have cash sitting in the bank or a money market earning zero," and they don't see that as a strategy. They see that as a lack of investing. Is that a fair differentiation?
I think that's exactly right. I mean, it's a part of any strategic plan or portfolio you do for any client. If you think about it, when you do a financial plan for an individual client, you say, do you have your emergency reserves? How are you going to, maybe I need to set some aside for a specific event in the future, not the least of which you say, I have to have this in cash because I can't lose it. So cash is, in fact, a strategic asset. It always has been. Just because it's not in the market, i.e. it's not buying any listed bonds or securities or funds or anything like that, doesn't mean it's not invested and doesn't mean it's out of the market. It means that it's a strategic piece of any plan and any portfolio. So we use it to manage risk.
Do you think normal people should use it that way also? In other words, let's say a guy looks and he says, wow, December, January, crazy markets, right? Whatever's going on in the market, he goes, I can see the volatility. Let me go to cash. Is that the type of decision someone who's managing his own portfolio should make?
And here I'm going to argue for institutions that can do certain things better than individuals. And it's as much to a certain degree as I dislike admitting it. The fact of the matter is, most people shouldn't say, well, I know what I'm doing with quote unquote timing, and I'm going to pull things in and pull things out. You get to a level of sophistication where you can say, I can monitor and manage volatility globally. In other words, I know what's going on in Asia, Africa, Middle East, Europe, United States, the Americas, things like that. And you can monitor those levels. Or if you're just sort of taking the temperature on what the market does when it opens that day, or in a given couple of days or week, that's a very different thing, right? And so most people, in fact, if you just look at it at that level of timing, they will always do worse in the market at short term, medium term, and long term. So what the difference here in this case is, we've got a track record of saying we can see over a long period of time with volatility management at a certain sophistication that we can outperform. So they're two very different things. and it has to do, in reality, with sophistication level.
So you're saying, and just to be very clear, that for regular people managing their accounts, using cash or any investment strategy they're competing, or they're simply not going to be able to do it at the same level that an institutional manager is. And tell me why.
Frankly, sophistication level. If you've got an institution, and in an example, in our case, our particular partner, they have offices in Asia, US, and Europe, and they're monitoring volatility. And that's their entire goal, is to manage the volatility to a certain level, right? The average investor who says, well, I don't feel really comfortable today, or I'm a little worried about things, I'll put more in cash. They're not necessarily, rules-based, and they don't have enough information to really make, the informed decision that over a long period of time will give them a successful track record of doing it.
All right, Chris, let's totally change the topic of the discussion, because
Sure.
At the beginning I mentioned something about rising interest rates, and you didn't seem to, bounce off the walls on that one. What do you think of the scenario that if interest rates go up even a little bit, the U.S. is not going to be able to pay the interest on the treasuries that are coming due all the time, and it could lead to a total breakdown in the U.S. government and economy?
I think there's some validity to that concern on paper. I think, the average person who runs a company or an organization or even their home, they look at that and they say, that's a real problem, right? The U.S. is a slightly different sort of a place. Basically, it prints its own money, and it is, for the moment, still the reserve currency of the world. So somewhere between, normally that's what would happen, and the U.S. being its own bank, there is a tension of where that will play out. I'm not sure that's actually going to be the case, although in black and white terms, that is what you would expect to happen, right?
Well, I'm not going to run and buy, I'm not buying guns and ammo and running out into the woods. I just want to know why.
Exactly. So there is a real concern about that. I think that's one of the reasons that interest rates have not gone up maybe prior to this. But interestingly enough, since we're talking a little inside baseball here, saw some research a couple weeks ago that said that when the United States got rid of quantitative easing, starting, I guess, a couple of years ago, the taper, and they brought down all of the, machinations with the balance sheet of the United States. In fact, including the 25 basis point interest rate increase that we just saw in December, there's actually been a tightening of 325 basis points in the last 2 years. It's not just 25 basis points. So in a sense, to your point, the debt service potential has gone up dramatically already, even though it's actually technically only seen a 25 basis point increase.
Mm-hmm. Huh. Okay, that's an interesting piece. So when we're done, you go ahead and email that to me. That'll be part of our private email that maybe we'll share with people. All right, we're just about out of time. In the last minute, just tell everyone, how can they follow you and follow your work?
They can go to my website at chanceryfa.com. I am on LinkedIn as well, Chris Cogswell. They can also go to our corporate website, which is prginc.net, Portfolio Resources Group.
Okay, so Chris, that's a great way for everyone to follow you. For those of you who didn't quite catch on, Chris and I are long-term buddies. We work together on a lot of issues. We certainly talk about the market, and I hope that some of you had some good insights about what we really do talk about, because this really is the type of conversation that we have after we usually talk about restaurants and traveling. Chris Cogswell, thanks very much.
You're welcome, Doug.
You've been listening to the Goldstein on Gelt Show with money maven Doug Goldstein. Doug's weekly radio show is heard around the world, but if you miss it, you can download the podcast at www.goldsteinongelt.com. The Goldstein on Gelt Show gives you up-to-date financial ideas so you can get on the path to financial freedom. If you'd like your questions answered on the air or off, send Doug an email to doug@profile-financial.com. It's your money for your future, so join Doug every week to build your wealth on the Goldstein on Gelt Show.